Welcome to the fifth lesson of the free academy. So in this lesson, we are going to cover the most important thing in trading, which is price action and reading the price action on your chart. So we are going to cover all the basics that you need, such as how to read a candlestick, but also how to spot any trend. Because what you need to understand is that the chart tries to tell you a story. And the thing you need to do is to learn how to read this story and learn how to communicate basically with the market, because the market is trying to tell you certain things. And the only thing that you need to do is pick up those clues and be able to trade off those clues. So let's get started. In first place, I wanted to talk about how to read candlesticks. So for most people, this wouldn't be that big of a deal, but I just wanted to explain it. Any candlestick has a high and a low. So for each candlestick, the high and the low is exactly the same thing. The highest point created and the lowest point created within a candlestick. Then you have the open and a close, and this is different for both bullish and bearish candles. So a bullish candle opens at the bottom of the body, so the thick part of the candle, and closes at the top of that body. Which means, let's say we have a 15-minute candle. In 15 minutes, the price has moved upwards. So for bearish candles, it's exactly the other way around. So at the top of the candle, we opened, and then at the bottom of the candle, we closed. So that's essentially what you need to understand about what a candlestick actually is. So just so you get a clear understanding, whenever you have a bullish candlestick, so a green body, this means buyers won. The price closed higher than it opened. So in the 15 minutes or in the daily, depending on which time frame you're on, but in one candle, the price is getting higher than it opened. So with a red body, sellers won. This means that the price closed lower than its open was. So within that day or within that 15 minutes, the price moved downwards. A wick is essentially the rejected part of a candle. So like as you can see, let me just try to draw it for you. As you can see right here, the price was able to move upwards in that 15 minutes, but it went down again. Then it was able to went down all the way to this level, and from there on it went up again to this level. So that's essentially what you need to understand about how a candlestick works and what a candlestick tells you. So this is the wick, these are the wicks, and this part is the body. I hope this makes some things clear to you guys, because you need to understand the difference between a candlestick body and a candle wick to essentially understand what happened in the price. Because if you can see a big wick, the thing that you can understand is like, hey, let's say it was a big wick at the bottom. Sellers were stepping in, but buyers took control again because the price went down, but it went up again. And buyers were able to drive the price higher. And that's something that you need to understand correctly if you want to understand how price action works. So we have three directions in the market, which are basically an uptrend, a downtrend, or a sideways market. This means for an uptrend, you create higher highs and higher lows. So buyers are in control essentially. And you mostly trying to look for long setups because you want to trade with the trend. For a downtrend, it's the other way around. You make lower highs and lower lows, which indicates that sellers are in control and you want to look for short opportunities. So the other part is that we have a sideways market. That like you create equal highs and lows, not necessarily exactly equal, but you don't create clear higher highs or higher lows. So you're not in a clear trend. So what you need to do here is wait for the breakout. And if you understand the concept of price action trading, you can understand that you always want to be in a trade before the breakout actually happens or occurs. But if you're on a lower time frame, just wait for the breakout and look at the higher time frame to understand, hey, this is what the price is telling me. This is the trend we're currently in. Because trading is essentially not trying to trade or not opening your chart on a 15-minute chart and you say, let's get to trading. No, it's making your market analysis, understanding which trend we are in at the higher time frame, and then we are zooming into the lower time frame to find certain opportunities to take. And the thing that you need to understand is with a sideways market, you still can make money, because I hear it a lot around me that people cannot make money in a sideways market, but it's very important to understand that no matter the market you're in, you can always make money in that particular market. So let's move on to the next, and this is support and resistance levels. And this is essentially what is going to give you your edge in understanding and getting to know where you can long or short the market. So a support level is a price floor where buyers step in. The price needs to have bounced off this level multiple times in the history of the chart. And with each successful hold, such a level gets stronger and stronger. For resistance level, it's once again the other way around. It's a price ceiling where sellers push back. So the price moves to a certain point, and right there, sellers are pushing back the price, and the price rejects because of this. In the history of the chart, you need to see that the price has rejected from this point multiple times. Same thing goes here for the resistance levels, just as for support levels. It gets stronger with each successful rejection. So whenever a resistance is broken, it can flip into a support level. The other way around, whenever a support level gets broken, it can act as a resistance level. So what you can see right here on the chart is that at this point, we moved to a certain level and we found rejection, meaning that this could be a resistance level. So what happens next is we move to a certain point which gave us support and price bounced off. So what we can do now is at this point, we can enter a short. Why? Because we are expecting the market to find resistance here again. And that's exactly what happens. And because we found resistance, market moves down. And that's where you can place your short. You can short the market at that resistance level. So that's basically how you need to look at the market. And one thing you need to understand is that the more times price respects a level, the more important that level becomes. Because if you have a price level with a lot of rejections, or if the price holds a lot of times, you can understand that the level is becoming more important, because not only liquidity is building up at that level, but all traders which are trading with support resistance levels, and essentially almost anyone is doing that. But that is the point that there is the most interest, and we as traders need to identify the edge and identify who is in control at that point. If you can identify who is in control at a certain point in the market, is it buyers or sellers? That's the point that you can understand, and you can actually get like, hey, the chances of the price moving upwards from here are getting bigger and bigger. And that's what you need to achieve as a trader. So then market structure, I just wanted to take you guys through this very quickly and briefly. It's not that hard. What you need to understand is that the market moves with a certain structure. Meaning we have a bullish and a bearish structure. Bullish structure means the price is moving upwards, we're creating higher highs and higher lows. This gives the signal that an uptrend is intact and we can potentially look for longs. A bearish structure gives us signals that a downtrend is currently intact and we can look for shorts. So a bearish structure looks like lower highs and lower lows. So just to visualize this, right here we create a low and right here we create a high. Then we create a higher low because this low is higher than this point, and a higher high because this high is higher than this point. Once again, higher low, higher high, and right here a higher low, and then we create a lower high. And this is the point that we need to keep in mind, like, hey, I see something is switching, I see the structure is shifting, and whenever we break that low, we are in a downtrend. So that's basically what it looks like, and then we create lower lows and lower highs continuously to confirm the downtrend, basically. So if you understand this concept, you understand the basics of trading, and you can understand where to spot reversals and how to spot reversals at certain important points or key inflection areas of the chart. And if you understand all these things, then trading will become so much easier, because right now the only thing left to do is finding your entries, finding your exits, and building your own game plan. And to build that game plan, you need to actually understand like, hey, the market is moving upwards, moving downwards, and this is what I can do. The moment you understand this, that's the moment you will become a structurally and consistently profitable trader. So this is it for the free academy, guys. I hope you understand a lot about price action and a lot about what is important to get started with trading. I wish you guys the best of luck with your trading journey, and I'll see you next time.